This is the first live webinar that we are having for the SheTrades Investment Challenge. Presenting today, we have Brindusa Burrows from the Ground Up project. I hope you were able to look through her profile that she has on Converve. We are very excited to begin our live webinars. These will be running until mid-June in preparation for the SheTrades Global event and more so the SheTrades Investment Challenge. So, Brindusa, let me hand over to you.
Thank you very much. Hello, everyone. It's a pleasure to be here today with you. I hope you can hear me well, just to check.
Yes, we can hear you.
Super. Sounds good. Well, then let's get going. The presentation that we're going to do today focuses on what venture capital looks for. And when we discussed the topic of the presentation, I realized that actually what we should be focusing on really is what impact capital looks for. And the reason this is the case is because venture capital is a very narrow type of capital that you want to reach out to in the world. But there are many other forms of capital and many other types of capital providers that you can reach for when you're looking for funding for your venture. I'm very excited to be here today and to introduce myself. I am the founder and CEO of the Ground Up project, a deal sourcing platform for sustainability that I will tell you a little bit more about in a second. I was an associate director with the World Economic Forum in Switzerland and responsible for creating and deploying a multi-country G20 program to leverage private finance into the green economy, and then stepped out to fund my own company. I'm also a Global Leadership Fellow of the World Economic Forum, and I thought it might be more interesting to actually show you my bio in logos so you can take a peek and actually see where I've studied, where I've worked, some of the countries that I've worked in. A quick word about the Ground Up project. I was saying it is a deal sourcing platform for sustainability. We're a financial technology company interested in impact ventures that are looking for funding under $20 million. It is relatively a segment that is hard to find capital for, and therefore impact investment actually represents an opportunity at this kind of scale. To give you a sense, we have companies on the platform that are looking for $50,000 and others that are looking indeed for 20 million or so. The scale of the platform functions on the basis of a value compass. The value compass is actually a free tool that you can use. It's a self-assessing tool. It helps you self-assess risk and performance that match with investor requirements. It's a tool that's approved with investors, and it runs you through a form where you can actually learn what are the key questions that investors will ask from you in the pre-due diligence process. The Investment Clinic is a product of the Ground Up project company. It specifically focuses on investment readiness, and it is part of the webinar today. We have put together a network of experts that can review your financial modeling, they can validate your revenue models, they can give you feedback on investment teasers, assess your pitch decks, and so on. We also have live sessions with investors every month for half an hour, and you can log in and ask your questions directly to an investor according to the theme that they invest in. We work with a universe of 10,000 plus companies, and here are some of the partners that you can see. Obviously, SheTrades is one of our key partners, and there are others in the UN universe, but also competitions and other accelerators from which we source businesses. We obviously work directly as well with entrepreneurs who would like to sign up and get in touch with us. Now, what will we talk about today? I mentioned some of these things already in the introduction. 10 points. What is an impact business? We'll be looking at characteristics and why it is important to become an impact business. Who are impact investors and what motivates them? We'll give a few examples of impact investment strategies. Characteristics of impact investments, obviously all of this from the perspective of the investors. We'll talk about the importance of the story that you want to tell to an investor, about what you should expect from the process of pre-due diligence, pre-selection. What are the investment decision criteria that investors are applying? We'll talk about type of capital entrepreneurs go for and some of the mistakes that entrepreneurs make when they choose what capital to go for. And then we'll talk about preparing for an investor and how we can help. So let's get going. What is an impact business? An impact business is a company that maximizes social environmental impact while realizing enough profit to provide investors with a healthy return on equity. And you will hear these phrases over and over, the return on investment, return on equity. I should pause here and say that investors are measuring their returns in terms of compared to the risk that the investment actually presents. So it is about a risk and return equation. And for them, the objective is to get that balance right, especially when they invest in markets or sectors that they're not 100% familiar with, which will make the risk actually go up and therefore the requirements on return go a bit higher. But put it another way, an impact business is actually a business created to address or solve a critical social environmental problem in a financially sustainable and potentially profitable way. It can be any type of legal entity, as long as it applies a financially sustainable lens to what it does. So here's some examples. Production of low-cost washing powder, effective at low temperatures. It obviously saves energy, it saves water, and it is a product that actually helps a number of people. Building affordable green housing in Kenya, providing housing, and at the same time, in an integrated circuit, it can actually work on renewable energy, it can integrate waste recycling and so on. Providing clean, drinkable water in water-scarce areas, I think it talks for itself. Here's another case, purchasing natural plants. In some cases, it could be organic, or it could be simply empowering small-scale small-scale farmers, for the health and beauty industry. Or providing financing for solar cells to poor communities in Argentina. I'm sure you will have your own examples, whether you're working in textile, you're working in IT, or any other kind of sector. If you're providing jobs and improving conditions for a target group in the society that will become your customers, then you are most likely probably running an impact business. Here are some examples from our site, and you will recognize some of these products that you see around you, I'm sure, every day. Now, why should you become an impact business? First of all, because of the financial returns. It has been now proven over the past 10-15 years of analysis that impact investment actually leads to higher performance over a longer period of time, which basically means that companies in portfolios of impact investors have been proven to be more successful over a longer period of time than typical portfolios of other mainstream investors. You can incorporate your personal values in financial decisions, and this goes both for the investor but also for yourself. And the capital that you receive or that you raise for an impact business can directly contribute to solving some of the greatest sustainability challenges. Enhanced risk management can lead to lower volatility. Again, it comes back to measuring risk, and measuring impact and sustainability in impact businesses actually undergoes a relatively rigorous scrutiny and monitoring over time from investors, which means that the business itself can benefit and reduce the risks related to impact, sustainability, or any other financial risks for that matter. Transparency. Again, going back to the practice of impact investment, It produces a greater transparency for portfolio decisions, which means companies that are in portfolios of impact investors have undergone a higher level of scrutiny, and therefore it's a stronger business. And when you reach out to follow on capital or even in the market, you can benefit from this label or this credibility, if you'd like. It is a niche. I mentioned this. The impact investment market is still growing, and as in any niches, there is an opportunity to be among the first in this space. And obviously, impact investor fosters entrepreneurships, and what we mean by that is that many of the impact investors actually contribute actively to helping entrepreneurs be successful in their businesses, because they want to create that change in society and for our environment. And therefore, they put a lot more than just financial resources towards it. Now, who are impact investors? Some of the most relevant investor groups in impact investing are NGOs, so a lot of not-for-profit foundations that are funding these opportunities, individual investors, they can be angels, family offices, so portfolios of high net worth individuals that are being managed in order to achieve a certain social or environmental goal, religious institutions, private foundations, development finance institutions of different governments around the world, fund managers, wealth managers, again, managing portfolios of high net worth individuals, banks, pension funds, insurance companies. These are also known as institutional investors. Diversified financial institutions, and obviously government investors through other types of agencies. And they have different preferences. You will see, for example, I picked some of the more, let's say, more extreme examples on the spectrum. The banks and pension funds, so the so-called institutional investors, will look for impact investment opportunities in more mature companies, and they typically look for large investment ticket sizes, as defined, anywhere above $50 million, or even sometimes $100 million as the minimum investment ticket. Foundations, they can pool significant funding. They typically work at a much earlier stage. Government investors, development finance, again, they work at an earlier stage, but they also sometimes can be guarantors for private sector investors. So they are an important player to have on board, because oftentimes having already secured a guarantee or a bit of investment from a public agency, whether it's a national government or a donor government, if you'd like, increases the attractiveness of the investment for a private investor who believes that they're sharing the risk already. Here's an investor matrix. I hope you can see this on your screen. I'm sure the slides will be shared afterwards, and you'll be able to read through. It's just to show that capital and impact investors, just like any other types of capital, they work along a continuum of maturity stages for your business. You start with the seed stage, you continue in an early stage of startup. At the mid stage, your company is growing. At a later stage, it's scaling. And a mature scale or at an exit scale, there could be a potential for buyout. Now, the types of investors you will see, typically, as I mentioned before, banks and private equity, public markets, so the more institutional types are more interested at the later stages. At the earlier stages, you will have grant providers, angel investors, incubators, government institutions, and venture capitalists who kind of span the middle ranges, between the early stage and the later stage. And you will see that the ticket sizes, as I was saying, vary greatly. From seed stage, much smaller amounts, 10 to 100,000, all the way to more mature companies, institutional investment that goes 10 million and plus. And I mentioned, some institutional investors, again, have really, really high minimum ticket sizes. Now, what motivates impact investors? Most of them want to make a financial return while they remain aligned with their core values. I mentioned this at the beginning. It is an opportunity for them to match their financial interests with something that they truly believe in. For philanthropic or non-recourse organizations, there's an opportunity to create a bigger impact. You're not just grant making, but you're creating self-sustaining businesses that over time are producing much greater impact and sustainable impact over time to communities that they operate in. For equity and debt investors, impact investing provides the opportunity to contribute to sustainable solutions to our social and environmental challenges by enabling more capital to achieve positive outcomes for society and the environment. Let's see, what are some of the examples of impact investment strategies? You would have heard of investment strategies, but what do they look like? So here's one, active ownership strategies. These types of investors are constructively engaging with the management of publicly traded company. So an investor investing in a publicly traded company may have an active ownership strategy. They want to influence the way the company is run. Oftentimes you would have heard of groups that are influencing companies in order to be more sustainable. This strategy is an active ownership strategy. Screening is essentially the other side to it, which says I'm going to screen out my investment in companies that are not sustainable, or I'm going to actually select specifically certain companies that are doing sustainable activities over some others who aren't. Impact first investments is a different strategy that you will hear very, very often talked about. Investors who are designing this strategy and follow this strategy, they specifically focus on desired outcomes. They want, for example, a certain number of housing units to be created. They want certain land to be preserved. They want a certain number of children to be immunized. So they first start with an objective, an impact outcome. Financial first investments is the other side of the coin. These investors look first for investments that generate specific returns and at the same time that are achieving impact. And then asset allocation, you would have heard about this as well, very, very common. It's an approach in which investors spread investments over different categories. They diversify across several asset classes in order to reduce the risk and volatility, while at the same time pursuing their return objectives. This is typically the case of asset managers, but it could also be the case of family offices or others that are managing portfolios. So what are the characteristics of an impact investment? It differs in terms of the early stage or the later stage. At the early stage, some of the elements have already been tested in the business. So an investor would look at the idea of the size of the market and the market share objective, whether you actually know what that looks like and you're able to put a number to it, the skills of the core team and whether the team is actually in place, and if you're still continuing to build the team to prove that you're building the team. The target customer segments is a very important element as well at the early stage, and also how you are going to prove these customer segments. If you have a product tests and development, growth plans, financials, your cost base, the investment that you need, and the impact that you are going to achieve. And we're talking here about sensible projections because obviously, impact, as many other things at an early stage, is not an exact science. Now, in the later stage, you have to have a more substantive demonstration of your business capability and execution of growth. You have to have higher precision in implementation plans in your growth and financial projections. you would have had some opportunity to test some of your initial assumptions from the earlier stage. So you would need to show a track record of revenues, achievement of sales, operational and financial commitment that you have set as a target for yourself at the beginning. You must show a growing trend of business, management team history and expertise. And here, oftentimes, investors are talking about the dynamic within the team as well, whether the team actually is not just composed of very good individuals by themselves, but how they work together and what is their, have they gone through difficulties? Have they overcome difficulties? What is their strength as overall as a team? You need to prove stronger market knowledge and detailed financial acumen so that you can back up your projections. And then you need to demonstrate the impact and your ability to measure that impact over time. So, how has impact performed vis-a-vis what you were hoping to achieve, and where are you going from there on? We'll have a bit of time to practice some of these things in a minute, so I will open the lines in a couple of minutes. Just a few more slides to go through. So be prepared if you'd like to jump in the discussion. I would love to have the chance to give you the space to ask questions, but also to test some of the things that we're talking about today. Now, here's the reason I picked this point to include in the webinar is because over and over and over, we hear from investors about the importance of a story. Many times we have been taught, by accelerators, by the books and so on, that you need to know your numbers. But the first time you approach an investor, and in order to get a meeting with the investor, which is one of the hardest things to do, is to get your first meeting, a story is much more important. A story about why you are doing what you're doing. What is the emotional dimension of the investment? Can the investor identify himself or herself with you, your entrepreneur, and your motivation? Can they identify themselves with the problem or the solution that you're providing? And then, what is your personal experience that has motivated you to start with? And that's when people actually connect to something, especially impact investors, connect to something that they see makes a difference for people and makes a difference for the environment. And they want to be engaged with someone that they believe in. Now, in terms of the process, what do you expect as a process when you reach out to an investor? It varies, the time and the duration varies greatly. There are impact investors who have more capacity than others, just like any other organizations. But roughly speaking, there are several stages for all of them. There's the first minute scanning, the first impression. It really is like a headhunter that receives hundreds and hundreds, sometimes thousands of CVs, and you basically spend maximum a minute just glancing through the one-pager or two-pager information. You need to be very professional in your presentation, very well targeted, and you have to have the key characteristics in a very short document, one or two documents, and they need to match the investor preference. If you do all these things, you've got a much higher chance of standing out for the investor and for your investment teaser or pitch deck to actually be selected in that first minute. Then they go back and say, okay, 5-minute screening, I'm going to do a closer review of the narrative. Now, what is the emotional connection, the logical flow, the business case? I'm going to look at growth rates, size of market, number of customers, and so on. At that point, I'm going to pick some of the key details in my head and see if they match the strategy and the investments that I'm making as an investor. Then there is a 1-week partner screening where you can go into the details on any of these issues. And what matters here is actually to provide the required details to the investor relatively urgently. We have seen cases where the company has come back to the investor maybe 3 weeks or a month later And in that case, generally, it is too late. And why? Well, because of this last point, which is that every 2 weeks, generally, this is the practice in most impact investments, there is an investment committee discussion. So at that point, the investment committee looks at the businesses that were selected in the previous stages. They discuss which they're going to select. But at that point, they need to go into a lot more details and see whether this company is worth getting into due diligence with. And will there be a chance of this company making it into their portfolio? They essentially will make a decision about whether to spend their money going into due diligence, money and time. So at that point, you obviously need to have a pitch presentation with a business case and impact, full details. Now, if you remember that 1 minute or 5 minute review, that will make it so that you actually do connect to an investor. Here are some of the criteria that they think about. Sector or impact theme. So here are some examples. It could be a business in agriculture, energy, housing, but you could also be a business in water or water purification. So you can go to as much level of detail as you would like to. Business maturity, they look at the stages that we talked about earlier, whether the business is a startup, is it in growth stage or mature. The funding range, I've put here a very silly example, but essentially you can fill in the blank with as much as the ticket size. Type of incorporation, so the type of company that you're putting forward. The place of incorporation, obviously country or region or city or entity. Business model, whether it's a for-profit, not-for-profit, social enterprise, which are generally considered as a hybrid. Scope of activity, whether it's local, regional, global. Whether there's also previous funding history, so have you raised money before, or is this your first attempt? And if you have raised before, then do you have other co-investors, and who are they? So they will look at these issues. Now, if you would like to, I suggest that we do a bit of practice. If you were to pick your elevator pitch about your business that would pass that 1 minute scanning test, knowing what you now know about these criteria that I will put again on the screen, who would like to give it a try to introduce their business and see whether we can package this 1 minute decision nicely in a way that actually makes sense to investors, and that they will recognize the criteria that they are applying in order to make that selection. So let's see, does anyone want to give it a try? And Matira, you have to help me here. I think we have an option for you to raise your hand if you'd like to give it a try, and then I think I need to unmute you, right, individually.
That's right. If you'd like to respond to Brindusa's question, you can either raise your hand or just write in the chat box and we will unmute your mic for you. Or you can just unmute your own mic, whichever you prefer. Thank you.
Thank you. So the question is, can you try an elevator pitch that would pass the 1 minute scanning test for an investor using the criteria that's on the screen right now?
Hello.
Yes.
All right, this is Tawani.
Hi, Tawani.
Hi. Sorry I came in a bit late, but I think I can give it an attempt. So, an elevator pitch talking about where my business is Kotoa with the relevant criteria. Is that correct?
Go for it. Yes.
All right. So Kotoa is a fashion label. It's in a growth stage. We're about 8 years old. The funding range we are looking for is about $50,000. We are sole proprietor, incorporated in Zambia. We are a for-profit organization. Our scope is we have been very much local, but we're looking at going into the regional and global market through online stores, and this is where we would like the funding. For our previous funding history, we have received a grant in the form of a business plan competition that we won first prize with. Co-investors, we're looking at definitely co-investors, and actually would prefer equity input to help us with our Afro chic design that uses local fabric, our Chitenge fabric, and modern contemporary designs, which have been well received, and with funding we feel could go further.
Sounds great. That's really good, and it's very great. Yeah, very good to learn about your company. Where are you based?
Oh, sorry, I didn't say that. Zambia.
Zambia. That is one of the key elements.
So I think I said it in the beginning before I said the pitch, but obviously it wasn't put in there.
Right. Now, in terms of just one thing I would come back to, which is the last point about co-investors. In an investor's mind, what co-investors refers to is who would they be coming in with? Because you have raised a grant before, you essentially have no other investors in your portfolio,
yes, that's true.
in your cap table. But you have raised a grant, which I think is an important element to underline, because it means you have had, first of all, you have passed someone's screening. They have given you a grant, and that grant has helped you achieve, no doubt, certain milestones. And so they're not coming at it with with a business that has never raised any money or hasn't had any resources, or is just starting to put things together. So co-investors specifically refers to whether there are other people already invested in the business in terms of equity. It can also refer to, for example, if you're doing a fundraise, whether you already have some commitments from others, or whether you already have secured a lead investor. We've already, depending on how much you're raising, in the 50,000, do you have a lead investor that has already given you, let's say, 10,000? Are there other people who have made commitments? And so, briefly describing who are other potential co-investors, or if they already exist in your business, then you would describe those. I think generally this is because investors, and especially impact investors, because it's a growing market niche, they like to look at who else has invested, and they would recognize other people's names, or they would judge their ability to make decisions about investing in businesses. So that's the important bit. And what would you say is the impact that your business is creating over and beyond the products that you're creating?
Well, I think the impact that the business has is really a shift in the local market to appreciate and enjoy wearing our local fashion, or wearing clothes that do reflect our history and, I guess, our culture. Because I think we were one of the first brands that used Chitenge, which is like a print woven fabric, for everyday contemporary wear. Before that, Chitenge wear was very much ceremonial, or what we call function-based. For example, if there's a wedding, or a bridal shower, or some formal event, people would wear it. So I guess our impact is helping that shift in people to be more appreciative of that. I guess an economical impact is we're very much based on imported garments here. So allowing that cultural shift to be more appreciative of our local wear means that a lot of that production can now happen in country. I mean, it's very much a drop in the ocean, but it's it's a beginning.
That sounds great. And are you the founder?
Yes, I am.
And what motivated you to start this business?
What motivated me is really just not finding the type of clothing that represented me as a modern African woman. I think a lot of our clothing, unlike in West Africa, where I think there is a lot more appreciation of local clothing, here it is like so Western. But I felt almost like an imposter wearing something that, yeah, it looks great, it's very professional, but it doesn't reflect who I am on the inside. So it was really about, it started off by really just creating garments for myself and my sisters, which was then appreciated by other people, and then started to make them and sell them.
That's really great. So if these are the kinds of questions that will actually get you an interview or get you a meeting with an investor. And from our practice, I would suggest that the way in which you would approach the question is first by introducing your motivation and the story. And I think it's a very important and very interesting. And all of a sudden, I can visualize what's going on and what your motivations were. Then you give the quick criteria that would match the way an investor would think through. So they'll be able to place the type of company, the ticket size, where this is, the markets, and so on. They'll have this in their mind, and then you end with the impact, which is the type of impact that you describe at a customer level, but also in terms of economic impact. So that makes it a really nice and round story. Thank you very much for sharing that with everyone.
Thank you so much for your feedback.
Sure. So let's see. What's the type of capital that you go for as an entrepreneur? It obviously depends on what is needed. So if you just need money, then probably debt will be fine. Obviously, you need to have a certain type of criteria fulfilled, and from your experience, access to debt is relatively complicated depending on where you are and the stage of your business. If you need active investors and access to networks and expertise, then you look into equity investors. Equity investors typically put in a lot more than just finance, and they demand a lot more than just returns. If you're a social enterprise or an NGO, obviously grants are your best, or non-recourse finance are your best and likely choice. Now, here are some of the things that we always see, not always, but most of the times we see, that will guarantee you to fail in reaching out to investors. If you reach out to an investor that doesn't invest in the sector that you operate in, so do a bit of research to understand whether the sector actually matches with their previous track record. That they do not invest in companies with the same track record as yours. And so in that case, they will not know, most likely, how to price the risks that may appear from your business. They would not know how to categorize certain types of costs and put them in context. So they will say no. Investors that do not invest in your desired instruments. So, for example, if you just need debt and it's an equity investor, or if you're looking for equity and it's a debt investor, vice versa. And then investors who actually do not invest at the time of your request. You may think that a fund or a certain type of investor, because they're online and they show that they've invested in certain companies, they're still investing at that time. But if you need to do a bit of research to understand whether they're still open for investment when you need that to happen. So all of these reasons are reasons for which an investor will say no and reject you. It does not mean that the quality of the business is not there, or that you don't have all the elements that they were requesting. It just means that it's just not a match because of these reasons. Now, here's another practice that we can do. How you apply for impact funding, and just keeping in mind some of the things that that we talked about until now, and also some new ones that we're about to introduce. Entrepreneurs often make the following mistakes when they apply for impact funding, and I'd like you to select those that apply. So who wants to give it a shot and pick a few from the list? I'm assuming that you can all read the screen, so maybe I should just read them quickly for you. Entrepreneurs do not use the required set of documents. Entrepreneurs do not comply to the information requirements set by investors. They do not prepare themselves properly to answer questions. They do not present the value of the team, and they do not think about the exit strategies. Now, which of these do you think are mistakes that entrepreneurs make when they apply for impact funding? Anyone? Savita?
Yeah,
Hi. Are you trying
hi.
to answer the question?
Yes, I have actually written. I think it's really okay. I'm speaking from India. Okay. Um, don't think of the exit strategy because probably we think it's too far out, and don't know what's going to happen then. So that's possibly really what my answer to your question would be for this particular thing.
Thank you. Anyone else? Hello?
Hello.
Yes.
I think also proper preparation.
Okay.
My name is Grace. I'm talking from Kenya.
Hi, Grace.
Hi. I think preparation is key. Yeah.
Thank you. Now, you are both right, and in fact, they're all correct. All of these answers actually apply. You need to have the right documentation. They need to match with what investors are requiring. You need to prepare to answer their questions. You absolutely need to put forward the value of the team, including that of yourself if you're the founder, and think about an exit strategy. I'm just going to pause for a second on the slides here because I see a question in the chat from Messeret, I think. Forgive me if I'm not pronouncing your name correctly. How do you come up with a really good exit strategy upfront to attract impact investors? I have an investor considering investment to an impact business, but asked me if I can come up with their exit strategy. I think there are several ways of going about this. One, and the most immediate that comes to mind, is to look into things that they've invested in the past and see their preferred exit. Have they invested in a company that then was sold? Have they sold their shares to another investor? So doing a bit of research and perhaps asking companies that they've invested in before is one way to go about it. The other way to go about it is for you to look into the market and see what are the options that you have in terms of acquisition, in terms of perhaps going public, any ways in which the investor actually can get their money back, essentially. And then I would add to that, actually, think about what your preferred exit strategy is. It's not just about the investor, but does it match what you're looking for? Are you in your mind creating a business that is there for generations that you're going to leave to your kids? Are you creating a quick startup that's going to grow in value and then you want to sell it and move on? What is your preferred? And then see if that matches with the exit strategy of the investor, because it's one of the most important points in a discussion with an investor. And very often it can create big conflicts down the line. I hope that has answered your question. Someone else is asking, About EcoTour's company, our EcoTour's company is Melissa. Hi, Melissa. Is in growth stage. We would like to expand into community-based eco resort. Is it possible to convince investors? It is possible to convince investors, and if I understand correctly, what you're describing is basically a different business line of a business that's already proven, and so there's a two-edged sword here. One is that you have the track record, so you can prove as a business person that you were able to secure resources, grow, work through your customer base, and actually create a successful business. So you can that card and that track record actually works for you in your favor. The fact that it is a new area, you then need to say, well, I am going to set myself a series of assumptions about how this is going to work, and I'm going to show you as an investor why I think it is going to work, and that's how you want to make the case. So you still need to make the case a little bit as if it was a new business, but you benefit from your track record. Now let's move on and look at the preparing for an investor. This is one of our biggest and last chapters. In terms of your survival kit, so what do you need to have with you? And we mentioned one of the mistakes is not having the right kind of documentation. The investment teaser is one pager that makes the first impression. And as you probably know, there is no second chance for a first impression. So it has to be really professional and contain some of the things that we just practiced earlier in terms of describing very succinctly your business. The pitch deck, which is usually a maximum 10 slides, if you can, professionally designed, rich in messages, and very light in words. So very unlike my webinar presentation today, a pitch deck needs to have the least words possible. Financial projections, at a minimum, income statement, balance sheet, and cash flow statements are a must. Obviously, if you're already functioning, investors may require your audited accounts. If you're in an earlier stage, these are all projections. The business plan, it obviously can take many forms. It can be used in different ways. It should be comprehensive and cover all the key business dimensions, and I'm sure you're all very experienced in writing a business plan. The fundamentals that should be reflected in your business plan: what is the problem and what is the market opportunity? What is the solution and what is the value proposition that your company is bringing? Why do you think you would succeed, and what is your competitive advantage? What is the execution plan, and what is your business model? How will you make money? When you do get funding from an investor, it is an agreement, a contract that will bind you with profound effects on your business, and therefore you need to think about your ownership structure, the type of incorporation, the jurisdiction. You have to think about the corporate structure, capital structure, vesting rights, and so on, and make sure that they don't just match what the investor is expecting, but what you would like to see in your business. And obviously, you need to project the future capital structure and define an exit strategy. We talked about this. Again, I would just like to stress, as in my answer earlier, that you need to also make sure that you get well rewarded for your work. Preparing for an investor with details. Investors want to know the cost to develop, start up, offer, and deliver services or products. Who are the potential buyers? What pricing model and level will apply? A detailed budget and projection of required investment linked to a plan that will prove how you reach the desired outcomes in terms of the market positioning, the financial return, and the impact. So in other words, any projections that you make must be justified. The potential return on investment and the return on desired outcomes in terms of the social and environmental performance. And overall, the investor's expectation is that you are capable to manage and anticipate both the risks and opportunities raised by the business. And that is, I'd say, a sort of a top-level argument to make in your conversation with the investor. Now, here's a checklist, and this is not necessarily a practice that we will do today as a group. But as you read through it in your mind right now, take a minute to actually see if you can answer all of these questions, which will be asked by an investor. And we're talking here about those who actually made it through the 1 minute and the 5 minute check. What is the problem that you are solving? Number 2, what is your idea or what is your solution that you're already proposing? Number 3, team. And you will notice this is the first detailed aspect that you need to present about your business. One of the most important things, because the team is the one that will deliver all the things that follow in the list. Number 4 is the impact, and we talked about social economic impact, environmental impact. Number 5, market size and potential market share. Number 6, your competition. Number 7, traction and future purchase commitments. Have you already made sales and where and to whom? Revenue and cost model. Number 9, key customers and key suppliers, if that applies. Number 10, intellectual property ownership. And let me pause here for a second again to say that IP only matters so far as you can defend it on the market. And what I mean by that is most investors know that IP is beaten, if you'd like, very quickly the moment another company and another startup, another person comes up with a better solution, a newer solution, and so on. So IP costs a lot, but it only has value if you, with your organization, with your team, and the way you're structuring your business, are able to maintain that advantage and make it an advantage on the market. Founders' ownership, compensation, investing rights, whether you have other investors, and the equity allocation. So in other words, what is your cap table like? Equity for future employees and directors, if you have a board of directors, or you will have one. Governance model, decision authority, signature rights, diversity, code of conduct, etc. The exit strategy scenario, the 12 months budget and 3-year financial projections, and then the business plan as a document. I hope you went through this list in your mind, and if you do have it all, then you're all set. If you don't, then do find a minute to actually work through these points, because they are essential in an investor's eyes. I see another question here, so let me pause and take that. Continuity with respect to generations. What if we do not have anyone from the founder's family who can take over? Then what will be the strategy? I mean, I guess this is a question that has multiple answers and very much depends, obviously, on the owners of the company. Whether you're willing to open up and get other investors in and share, obviously, the capital. That is an important question to ask yourselves, and I'd say it's the primary question to ask yourselves. The other option is to then obviously recruit someone who can actually run the company and raise money independently. But either way, very often in family businesses, they need to ask themselves whether they're willing to change the capital ownership in the company. Let me move on, and I'm just going to go very quickly over these because we've addressed these before. The 4 questions that are the most important but the most difficult to get right. What is the total addressable market? You don't need to be incredibly precise, but you need to prove that you know how you're going to find the right answer, how you're going to go about testing it. Who are your competitors? your direct and indirect competitors and understand the behavior of the target customer group. How much money are you raising? And the rule of thumb is to have a 12 to 16-month runway. Or the other way to decide that is whether the valuation is 3 or 4 times the funds that you're going to raise. And then the last one, what it will be used for. Are you ready to fundraise? Then that is the question. I'll leave you with a cartoon that says, this company that's selling tuna sandwiches over internet actually doesn't deliver them. I hope you get the joke. Impact investment in women entrepreneurs is no different. The only message that I'll leave you with on the slide is that you need to be prepared exactly the same way as any other entrepreneur. The same level of investment readiness will be required from investors. And finally, how we can help? Well, we can help you become investor ready. You can register yourself at groundupproject.net and get your free Value Compass score, go through the questionnaire and see if you're able to answer those questions. And then get in touch with us in order to access experts and work with us to work on your investment readiness, work on your fundraising, work with you during the fundraising and after the fundraising if you need that. On the investmentclinic.com, you will find also videos, investor lectures given by investors. And like I said, every month for 30 minutes, we invite an investor who comes live and can answer your question. You can introduce your business and you can test the pitch like you tested today. Test them to understand what their strategy is and what they're looking for. The next live clinic will be announced on the investmentclinic.com in the next couple of weeks. And with that, if you do have further questions, given that we unfortunately do not have more time today, please write to us at info@groundupproject.net. The team and I are there to answer your questions. And thank you very much for your attention. And thank you again, Watira, for the opportunity.
Fantastic. I hope that you found this session helpful. It's been very interactive, and we will we'll send out a recording to you following this. So thank you for joining us, and we look forward to you joining us next week for the next SheTrades Investment Challenge webinar. Thank you so much to Brindusa and the team at GroundUp for having kicked this off for us. Thank you. Have a good afternoon.